Good afternoon. I think we're all assembled now. On behalf of the Georgetown Center for Business and Public Policy, I'd like to welcome you. I'm Marcia Mintz. I'm the managing director of the center. We're an academic research center housed in Georgetown University's McDonough School of Business. The center was established in 2002 to encourage thoughtful discussion and to share information on a wide range of economic issues in the public interest. The Georgetown on the Hill series is one of our venues. It's actually one of our very favorite venues, and we are delighted that you're here to join us today. I'd like to introduce Bob Vastine, Senior Policy Fellow at the Center, who will moderate the panel and introduce the others. Thank you.
Thank you very much, Marcia, and welcome everybody. This discussion is very ambitious. Data flows, financial services, and the global economy, the TTIP opportunity. How are we going to weave all that together? Luckily, that's for our guests, our speakers to decide. Our premise here is that the TTIP holds the potential to bring new cooperation in financial services regulation between these two great economies and to secure the open data flows necessary for the world's vast financial networks to support the global economy. As observers, including some of the people at this table today, have indeed already observed, the TTIP has not shown signs of fulfilling its very great promise. A restart has been called for, a restart that would recognize that this is not just an ordinary FTA. Meetings over the last few days between Ambassador Froman and Commissioner Malmström have given us no inkling that a fresh approach will be taken. Both have confirmed their confidence in the existing framework. Malmström has restated Europe's goals, asserting that it will not do, including not modify EU privacy rules in a trade negotiation. The US has indicated no willingness to begin to discuss financial services regulatory cooperation in discussions with the Europeans. So there is yet no sign of the bold, fresh start that is needed to move these negotiations beyond the commonplace. Well, that's all my opinion. To discuss this complex web of issues, we have a very gifted panel. Dr. Brad Jensen is professor of economics and international business at Georgetown and a senior fellow at the Peterson Institute. He is the author of the foundational book on global trade and services. Stephen Ezell is senior analyst at the Information Technology and Innovation Foundation. He has spoken and written widely about the importance of data flows to innovation, and he is a graduate of Georgetown. No small matter. Brad Smith is Chief International Officer of the American Council of Life Insurers. I've had the pleasure of knowing Brad for 20 years and can assure you that he is most thoroughly in command of regulation in the insurance sector, whether it be European, Chinese, or Brazilian, and a lot of others. And he's in charge, and he's fully knowledgeable and active, an activist in the efforts to revise and strengthen insurance regulation under the G20 process launched during the financial crisis. Rick Johnston is Managing Director for International Government Affairs at Citi, a lawyer and former staff member of the Finance Committee. I've had the privilege of knowing and working with him as one of the most astute government affairs executives in Washington. So let's begin with Brad. If you want any more detail about these bios, they're, I think, in your package. Brad Jensen.
Thanks, Bob. So Bob asked me to make some very brief opening remarks to try to put some context on this conversation. So this is my personal view on the opportunity and challenges that TTIP affords. The US and the EU are similar economies with similar values. Very large market economies committed to open trading systems. I think that our shared values are stronger or that are more common when compared to some of the other large economies in the world. Think the BRICS, Brazil's, Russia, India, and China. In addition, our economies are quite similar in their structure. The US and the EU are service economies. We are, relative to those large emerging markets, relatively skill intensive and have comparative advantage in activities like financial services. I think both economies have a strong interest in preserving the open trading system that together we have pioneered in the post-war period. I think that a foundational source of the U.S. and the EU's ability to steer the global trading system in the post-war period has been how large we are. The fact that we accounted for the majority of global economic activity. That is rapidly depreciating. Together, the U.S. and the EU now account for about 45% of global GDP. So we are shrinking relative to the global economy. I think that there should be focus and urgency in working together to set the rules of the game for the global trading system for the next several decades. So I think now is the time for the U.S. and the EU to work together, and TTIP seems to be an important opportunity to flesh out those rules. The U.S.-EU economic relationship is very important to both partners. The U.S. and the EU are very important to the global trading system. Both account for 30% of global trade in goods and 40% of global trade in services. We are each other's biggest trading partners. And we are the biggest source of foreign direct investment and the biggest destination of foreign direct investment for both economies. So we are tightly linked. So there are natural reasons to want to pursue a large trade agreement to ensure continued free trade and investment. Both economies are relatively open. Tariff barriers are low. Much of the friction in the two economies is in areas like regulatory coherence. So this is where financial services provides some of the challenges and some of the opportunities in kind of a nutshell. Financial services sector is important for both economies. Financial services, as we saw in the financial crisis, is the crucial lifeblood of an economy. If the financial system locks up, the economy locks up. So this presents particularly daunting regulatory issues that we need to come to grips with. These are not just US-EU issues, but all countries face this. So we need to find a way for agreements to recognize and accommodate these regulatory differences without creating discrimination against non-domestic firms. So again, in terms of interest, both the US and the EU have large competitive financial services sectors. Together, the US and the EU account for 70% of global exports of financial services. In terms of where things stand currently in terms of regulation, the OECD Services Trade Restrictiveness Index ranks the US as slightly more trade restrictive than a number of the large EU economies, UK, Germany, and France, for both commercial banking and insurance. But both are, both the US and the large EU economies are significantly more open than, say, the BRICS. So what are the issues in financial services in the TTIP? So I think there are two that are focused today. One is on regulation, and specifically macroprudential regulation, which is how do banking regulators ensure that banks are viable? And countries differ in their approach to this. Countries within Europe differ in their approach to this. The EU and the US differ in their approach to this. So I think a big challenge to including financial services in the TTIP is finding a way so that the agreement can accommodate regulatory differences without presenting discrimination against foreign firms. So examples of the types of issues that come up with macroprudential regulations, things like capital requirements. So how much capital must banks or other financial services firms hold? What is considered to be safe capital? What is considered to be risky capital? So there are lots of kind of in-the-weeds details that banking regulators need to define, and there are national differences in how these are addressed. So there is concern, I think on the US side, about including this, that somehow including financial services would tie regulators' hands. I think that this concern is widespread, but I think that the US and the EU are the right economies to try to address this concern. A second issue that Steve will talk about in more detail is data flows and the need for data to flow to support global economic activity. Again, for financial services, the Bureau of Economic Analysis estimates that over 90% of US financial services exports were ICT enabled or digital data exports. So these flows are crucial to the financial services sector and indeed to most economies. So Steve will talk more about the details of differences between the US and the EU, but I think that we need to find a way to accommodate different regulation within the TTIP. If we can't find a way between the US and the EU where we share many similar values, it's difficult how to see how the US or the EU alone could negotiate with China, Brazil, or India. So I'll turn it to you, Steve.
Great. Well, thank you, Bob, for the introduction, and Brad for the nice overview of the topics we're going to discuss today. So, as Brad talked about, the reason data flows matter is because digital innovation is really the key driver of global economic growth. In fact, a recent study by Tekes, that's Finland's National Agency for Science, Technology, and Innovation, finds that by 2025, half of all value in the global economy will be created digitally. And open cross-border data flows is key to that digital innovation. In fact, a study by the Swedish National Board of Trade called No Transfer, No Trade finds that half of all global trade and services globally depends on access to open cross-border data flows. And as Brad, you say, that percentage is even higher in the financial services industry. Because of this, localization barriers to digital trade, such as local data storage laws, requirements to use local data centers in the provision of digital services, restrictions on cross-border data flows, or proposals to build geography-specific information technology infrastructures, such as national or regional cloud networks, threaten to profoundly fragment the internet while adding unnecessary costs to the global provision of ICT and financial services and unnecessarily impeding the global flow of digital information. Accordingly, it's quite disconcerting that, particularly in the wake of recent revelations about US surveillance measures, that the European Union and several European nations, most notably Germany, France, and Spain, have proposed or implemented a number of policies that threaten to significantly restrict open data flows and trade in ICT services. While nominally these policies are being promoted to, quote, protect the privacy, safety, and security of European consumers or businesses' personal data, the reality is that in many of these cases, the policies represent old-fashioned protectionism tailored for the digital age. And they represent a significant threat to the $162 billion worth of digital services the US annually exports to Europe. Let me address three issues in particular. First, Europe's newly proposed data protection rules. Second, calls for a European-specific internet infrastructure, also dubbed as the European cloud. And third, various calls for internet data taxes across Europe. First, in January 2012, the European Commission proposed to significantly reform the EU's data protection regime through what's called the General Data Protection Regulation, or GDPR, which seeks to establish a single European-wide data protection law. The GDPR proclaims data privacy to be a fundamental human right, introduces a right to be forgotten, which Europe is attempting to apply not just to Europe, but to make it a global internet standard, and proposes significant fines as high as 100 million euros, or up to 5% of an enterprise's annual revenue, for firms found to be in violation of European data protection laws. This is an eye-popping sum that would clearly be untenable for firms such as Google. Moreover, worryingly, the GDPR's proposed data protection rules could seriously undermine the business models used by many US internet and financial services firms. For instance, they could bar the practice of selling anonymous data to third parties, and they would significantly curtail the effectiveness of online advertising and business data analytic tools. For instance, the regulations would limit or preclude internet companies and financial services firms' ability to use targeted online advertisements to users based on certain protected categories of data, such as an individual's race, gender, ethnic origin, political opinions, or religious beliefs. The common practice in the United States of seeing a pop-up advertisement to if you're searching for a wedding ring or going to camp with your kids, if you're using personal data, or if you were building a financial portfolio for customers based upon the fact that they recently bought a car or a house, this would be precluded under Europe's new general data protection laws. I think it's important to note that while these policies would significantly harm US enterprises, they would actually inflict even greater harm on the European economy. In fact, a recent study by Citi, that's a Brussels-based think tank called the European Center for International Political Economy, finds that if Europe does move forward with this stringent implementation of the general data protection rules, it will cost the European economy at least 0.4% and as much as 1.1% of GDP per year. A related concern is the status of the EU-US Safe Harbor Agreement. Europe only permits information of EU citizens to leave the European Union if the European Commission considers the receiving country's data protection regime to be, quote, adequate. Since 2000, the Safe Harbor program has allowed US firms to fulfill this adequacy status by self-certifying with the US Department of Commerce that they meet Europe's rules for the protection of consumer data. The program is indispensable to enabling the flow of digital information between the US and Europe, but unfortunately, the European Union has recently demanded that the US make at least 13 changes to the Safe Harbor protocols, and European concerns here are currently under consideration by our FCC and USTR. A second issue pertains to proposals made by European policymakers, including no less than German Chancellor Angela Merkel, that Europe needs to build its own European internet infrastructure designed to keep data within Europe. For instance, Deutsche Telekom, potentially with the backing of the German government, has recently proposed creating a Schengen area network in which all European email traffic never leaves European borders. France has made extensive efforts to enact this policy and to build local data center infrastructure through a policy it calls Les Clouds Souverains, or the sovereign cloud. As part of this, the French government is directly investing in two cloud computing enterprises, Numigi and CloudWatt, as French national cloud champions. French Digital Economy Minister Fleur Parolin noted that France's goal is to locate data centers and servers in French national territory to, quote, build a France of digital sovereignty. Finally, France has called for a data tax on the collection, management, and commercial exploitation of personal data gathered by users located in France. In other words, if Google offered you a search result or Amazon offered you books, movies, or music recommendations based on your previous searches or purchases, France would tax this untoward use of your personal data. Such a tax would effectively become a tax on the export and use of digital data. This is separate from the so-called Spain Google tax implemented in recent weeks, which will require news aggregators to pay a fee to newspapers every time they link to a newspaper's stories in their articles. In conclusion, a few weeks ago, Juliet Garside wrote in The Guardian that, quote, Brussels and Berlin are mobilizing to defend the digital environment of Europe's inhabitants. Their enemies are the Silicon Valley corporations that seek to dominate it. This is misguided. The digital economy works best when it is a global and open economy. Therefore, we need to complete a transatlantic trade and investment partnership that precludes countries from implementing localization barriers to trade, that maintains strong protections for open cross-border data flows, and maintains the safe harbor framework that enables digital trade between the US and Europe to flourish while recognizing that both communities will take fundamentally different approaches to privacy and data protection.
Well, Brad Smith.
Thank you. Thank you, Bob. I just would, maybe to get a little more granular here, the U.S. and Europe are the world's two largest insurance markets, and I work specifically for the life insurance industry, but I can address this for a cross-cutting basis. So Europe represents about currently 36% of all dollars or euros spent globally on insurance premiums for life, non-life, health, et cetera. The United States represents about 29% of the premium volume done in 2013 on a global basis. The interests and the commonalities that the U.S. and Europe share are, fundamental in terms of we are both heavily insured markets. If you look at the per capita spending on insurance, the United States and Europe are roughly on par. There are some jurisdictions that have much higher rates of insurance because maybe they don't have a national welfare state, or because there are not efficient banking mechanisms for private protection. There are countries that spend a tremendous amount less because they don't have a developed financial services sector, either because they just have a really low per capita GDP, or because the regulations do not allow for markets to be competitive and for innovation to occur. The U.S. and Europe have similar profiles in terms of the size of our companies and our global competitiveness. So in the United States, approximately 20% of the capital that is invested in the insurance industry is European capital that owns U.S. insurance companies. And in Europe, it's around 15% of the capital that's deployed in Europe for insurance and reinsurance is U.S.-based capital. So we have a very robust two-way trade. And most people don't get into the terminologies of insurance, but I can just describe there are wholesale and retail levels of insurance. So what the names you'd be familiar with in the United States would be, say, Transamerica, which is actually owned by a Dutch parent corporation, Equitable, which is owned by a French parent corporation, Fireman's Fund, which is owned by a German parent corporation. In the United States, they're similar U.S. companies that go under a different name because they've acquired a European company over time. What is even more interconnected in our two markets is the wholesale form of insurance called reinsurance. So one of the fundamental principles of insurance is to transfer risk. So if a homeowner purchases insurance from an insurance company, that insurance company, as part of what is called its risk management plan, will not invest that premium in the house next door to the house it's insuring. And that would be because if there's a hurricane, earthquake, flood, whatever, they would not only have to pay the claim, but the asset that they are investing in to pay the claim, they want to have as geographically diverse as possible. So there is a risk-sharing mechanism called reinsurance. And the United States, approximately 3/4 of the reinsurance capital that comes into there, that is used by the U.S. industry, is offshore. And that is primarily with Europe, both European communities, Switzerland, quite a bit of it also is Canada, some Japan, some Bermuda for certain kinds of catastrophic risks because of Bermudan capital rules that promote investment in catastrophic risk insurance. The efficiencies and the need for coordination between the U.S. and Europe is not only because we invest in each other's markets. That's important. The U.S. regulatory system and the European regulatory system both are not at the what I would call the federal level. It is the term member states in Europe means countries, And we say states in the United States, we mean states, Alabama, New York, New Jersey. Regulation of insurance in the United States is undertaken at the state level, and regulation in Europe is undertaken at the member state level. So trying to work on commonalities and coming up with a coherent, compatible, mutually recognizable regulatory system between two systems where the regulation is not done by the central government in the United States or by the European Commission is difficult. But the need to do it is fundamentally important. I'll just, a couple of examples. After 9/11, 3/4 of the capital that came to pay insurance claims came from offshore reinsurers. Katrina was about 2/3. And that's important because it helps maintain reasonable prices in the United States. Because if we have a series of catastrophic events, the market, the rates for homeowners insurance or business insurance, whatever, are going to go up precipitously because there's going to be a lack of capital being willing to be invested in the U.S. market. But if you can operate on a global capital basis where capital can be deployed where it is needed, that allows for much more flexibility and much more efficient use of capital, therefore better coverage and lower costs. The U.S. and Europe have tried working to understand each other's systems and be able to trust in each other's national or what we would call state level supervision for about the last 20 years. And it's been recognized that the U.S. and Europe have a tremendous amount in common, and that they should do everything possible to avoid any unintended conflicts, any additional costs that would raise prices for consumers, limit availability of certain types of cover. The challenge with this is insurance regulation is very much a sovereign responsibility. It's because of the long-term nature of the business and because of the fact that you're taking premium one day for a promise that you will pay someday in the future, whether it's within 6 months on your auto insurance or on 20 years if you're buying a retirement annuity, requires a great deal of trust. And that trust usually comes with a great deal of government oversight, strict what's called prudential insurance regulation. And the United States and Europe have taken different technical approaches to achieve the same outcome. The same outcome is consumer protection and market stability. But the way we get there is different. The U.S. system has relied on what's called a risk-based capital approach, which relies on heavy amounts of data, a great deal of predictive analytics that's undertaken by state insurance regulators, and intense oversight once certain trigger levels are reached in risk factors within the analytics. Europe has followed what they call a prudent person model, which is much more hands-on, much more regulatory judgment applied on a case-by-case basis for regulators. The U.S. and Europe have recognized that we achieve the same outcomes, but we take a different approach, and are trying to work to increase the efficiency and their ability to recognize each other's elements of regulation. So where this fits within TTIP, you may have heard that financial services has been excluded from TTIP. And there are two parts of TTIP operationally. One is on prudential supervision, which has to do with regulatory matters. So it would be one country recognizing an element of regulation of the other country and not having to carry it out in its jurisdiction. And there is market access, which is traditional trade, including national treatment and transparency. And I'm always find it necessary to remind myself that TTIP ends with the word partnership, not agreement. This is not an FTA, this is an FTA plus. And the United States in the TTIP had said that we are willing to negotiate the market access component to TTIP, and Europe had said maintains they wish to do both, negotiate market access and prudential, so the regulatory component. There has been a negotiating dynamic that Europe has basically indicated unless Prudential is also included in the scope of TTIP, they are no longer going to continue to negotiate market access as an incentive to try and get the United States to include Prudential. From our standpoint, as a offensive concern, we do not have market access barriers in Europe, and effectively Europe does not have market access barriers in the United States. This is largely because both jurisdictions are signatories to the 1997 Financial Services Agreement, which contains pretty strict bindings on traditional market access barriers. The existing reservations that the U.S. has taken are largely for prudential reasons, so they would fall outside the scope of a traditional trade negotiation anyway. The reason Europe wants to include prudential supervision in the TTIP is a desire to be able to be more efficient in its deployment of capital. They believe that European reinsurers, again, it's approximately 3/4, 2/3, depends on the risk and the year of the reinsurance capacity in the United States, currently has to place collateral in the United States equivalent to all of those risks for the primary insurance company to be able to get regulatory credit for it. Europe would like to be able to get credit for, depending on the credit rating of the individual group, that could be lower. Our state regulators have recognized this and are currently passing what is called a model law, which the states adopt a model that then the state legislatures independently pass legislation so it can be adopted eventually, incrementally at a national level in the United States. I believe we're currently up to 19 states have either passed or are actively considering reduction in collateral for reinsurance in the United States. Europe has indicated that as a very positive development. The quid pro quo in this is the United States companies also would like to be recognized as regulatory adequate and that the U.S. regulation meets European standards under a recent revision to the European solvency regime called Solvency II. And the objective of Solvency II going back 15 years was actually to lower capital requirements in Europe. But after the financial crisis, the political dynamic changed and the capital was raised for European companies. And so U.S. companies have a financial incentive to have the United States declared an equivalent jurisdiction, i.e. having the same adequacy of consumer protection and prudential supervision as defined under Solvency II. This process will begin in 2016, and the U.S. has been having ongoing dialogues with the European Union, the European Commission, to educate the Commission on why we achieve the same outcomes in terms of consumer protection and market stability. These are taking place outside the TTIP discussion. There is a project called the U.S.-EU Regulatory Dialogue Project, which is now in its third year. It is comprised of a four-party talk, two European, one the European Commission, and the second a advisory body made up of the member states regulators called EIOPA, European Insurance and Occupational Pension Authority. In the United States, the two components are the state regulators, as represented by their association, the National Association of Insurance Commissioners, and the U.S. Treasury Department created an office called the Federal Insurance Office under the Dodd-Frank Act. Those four parties have been exchanging technical reports and have drafted, at this point, 3 updates on the mutual understanding they've been able to reach about each other's systems. So they've identified 7 key elements of regulation, whether it be group supervision, group solvency, data reporting, risk protection. One of them that relates to the specific topic here is confidentiality of information and professional secrecy. And when we talk about data privacy in financial services, we're not only talking about consumer information, we're talking about company information. So If a company has financial information, that information, it needs to be protected for a number of legitimate public policy reasons: insider trading, stock manipulation, fraud, other reasons. That where if a regulator collects the information, it needs to be guaranteed that it is safe. Otherwise, the company can be subject to liability from securities regulators. One of the elements that is being worked on under the transatlantic or the US-EU regulatory dialogue is to understand and be able to self-certify the equivalence of confidentiality and or professional secrecy. There are, again, differences in approaches. In the United States, we call it confidentiality. In Europe, it's called professional secrecy. The fundamental difference is if a regulator in the United States leaks information, by and large, a state insurance regulator, it's not a criminal penalty. In Europe, it is, and it follows them through their lifetime, whereas in the United States, it only exists while the individual is a regulator. This is a necessary precursor for the US and Europe to be able to come to any meaningful understanding and equivalency determination, because they need to be able to share information. And if they can't share information, we can't increase efficiency. I realize I'm running over time, and I'll be happy to answer any questions when we get to that section. Thank you.
I told you he was an expert. Next, Rick Johnston, Citi, with a wrap-up.
Thank you, Bob, and I will...
An overview, the vision.
No. This actually, what I wanted to try to do was maybe give some thought to where we can go given the current divergence of position by the U.S. government versus the Europeans with respect to the regulatory cooperation dialogue that the Europeans favor, but the United States financial regulators are not particularly enamored with at the moment. First, let me say, and I think this would hold true for virtually every financial institution, no one is opposed to financial reform. That is a given. And I think that we've seen over the past 8 years or so that there's a lot of that going on, in which, to a certain extent, the financial institutions have been engaged, but to probably a more limited extent than prior to 2008, for probably more political reasons than anything else. But the fact of the matter is that there is a lot of financial reform still taking place. A lot of regulations still have to be adopted, particularly under Dodd-Frank. And Citi, as well as the other financial institutions in our sector, all are supportive of that. The one element, however, of the financial reform effort that seems to be missing is a defined mechanism by which regulators can collaborate and discuss regulatory reforms within their respective jurisdictions. It is still the paradigm that existed prior to 2008 by which these consultations take place, and they're relatively ad hoc. As Brad's presentation pointed out, as did Steve's, we've got a real challenge confronting us in a globalized economy for regulators to be conversing with one another and trying to reach some form of coherence, rather than erecting national systems that may or may not, and too often it's the may not, correspond with one another, thereby forcing entities like Citi, we operate in over 100 countries, to have to comply with each set of national laws and regulations. You can imagine the compliance costs are astronomical. And one of the things that we feel in the financial sector is possibly going to be a key contribution, not only to our ability to deliver our financial services to our customers on a transnational basis, which is how business is generally conducted nowadays, is for these regulators to have a more formalized and defined mechanism by which to consult. Now, I want to reiterate and make it very clear. We are not talking about any kind of step toward undermining Dodd-Frank, changing any national jurisdiction's laws. What we are simply proposing, and this is something that the European Commission has proposed within the context of the TTIP negotiations, is a mechanism for a process of consultation. Nothing more. It is a process. Now, within that process, certainly one would hope that the regulators would abide by certain, what one might call principles. But one of the things we're looking for, or I think there are 5 elements at the very least that we would like to see embedded in this mechanism, this defined mechanism in this process. One would be to commit to having a dialogue amongst the relevant regulators on a cross-border basis, in this case the Europeans and the US, at the outset of the regulatory activity, not at the tail end, so that you can establish some sort of an understanding as to what are we talking about, where are we going, what are the objectives. The second point in this mechanism would be, therefore, to serve the idea that issues, frictions, if you will, would be identified early on, rather than at the end of the day when, obviously, as most of us know who work with government, unwinding something once a government activity is being undertaken, a regulation's established, a law is made, unwinding that because it's proven to be ineffective or, in fact, contrary to the intent of the action is very difficult. So identify the frictions early on. Second, try to coordinate timetables. As we have seen between the European processes and the United States processes, particularly in financial regulatory reforms, they have been really uncoordinated. Sometimes years in difference of implementation dates. Clearly, when you're operating a business and you're trying to be compliant with those laws or regulations, having to comply in 1 year with one set of regulations and then waiting for 2 years for another set of regulations can be an exceptionally costly proposition. And, you know, we are in the services business, so whatever costs we incur somehow will find its way into pricing for the consumer. So ultimately, the customer also suffers. Another item that would be useful in a mechanism such as what we are suggesting and what the Europeans are proposing is to build in a proposition for conflict keyword management, not dispute resolution. And I know there's great fear amongst regulators and legislators that, oh my God, we're going to hand over what we're doing to some third-party tribunal who can tell us we're doing something wrong or we're doing something right and we've got to change our ways. That is not what we are suggesting. We are suggesting simply that where there are frictions, where there are conflicts in one regulatory approach versus the other, that this mechanism can allow for some more coordinated management of that conflict. It would not resolve it necessarily, but perhaps it could mitigate the impact on not only the financial institutions, but again, on the customers and the companies that use our services. And then last but certainly not least, through this kind of a dialogue, through this defined mechanism, we would hope to at least try to support the efforts by regulators to reach an understanding of what or where you could reach mutual recognition. As Brad alluded to in his comments, there is this process going on right now where there is at least a discussion of trying to reach understandings for mutual recognition, so that if you're compliant and you're meeting the objectives of the regulatory regime in one jurisdiction, you could be recognized by the regulators in the other jurisdiction as having ultimately fulfilled that purpose and therefore no need to be, quote, re-regulated. So those are sort of the 5 elements in it. I think there's been a lot of mythology that has been surrounding why or what purpose there is in this effort to reach financial regulatory cooperation. Sometimes it was about, oh, you're trying to undermine Dodd-Frank. Absolutely not the case. Are we trying to make Dodd-Frank and other financial reform actions more efficient in their implementation? Sure, why not? That's just simply good regulatory practice. Some other arguments are being made. Well, existing mechanisms prior to the 2008 date, I might point out, are more than sufficient to meet this need. Not the case. Clearly, one of the parties, in our case the Europeans, feel that the existing mechanisms are not sufficient, that there needs to be more of a commitment, more of a process, more of a defined discipline in the dialogue than currently exists. And we in the financial community, both in the United States as well as in Europe, subscribe to that and believe that that's the case. So this is where we're really coming from. And I think that unfortunately the people who are concerned about their own right to act, they're concerned about their, let's say, their proprietary activities with respect to certain topics, their ability to act on their own and then have others follow. This is why I think this whole notion is being challenged. Because when you really cut down to it, all we are talking about in the financial community is trying to adopt the best practices on a cross-border basis for financial regulation.
Well, thank you very much. That's terrific. Let's begin with some questions from the floor. Who's going to be first? Want to draw straws? Go ahead, Doug.
Well, this is a question for Mr. Johnston. Just on that last point, because this is kind of an area I struggle with. So is the resistance from the regulators because they have their own reasons for resisting? Or is the resistance more political in that Congress doesn't want the administration to do this, and that's why the administration is resisting?
Well, I think when you look at what's really motivating the current discussion, and the good news is this is a very important topic, and a lot of people are talking about it, a lot of people are considering it, largely motivated by the G20, largely motivated, which, as we know, was really called together and reinvigorated by virtue of the financial crisis, and in which, in the Pittsburgh summit, I think it was 2009, there was a very specific recognition of the need for this kind of regulatory cooperation, at least by the heads of state. As all of us know who have dealt with the regulatory community, regulators tend to focus strictly on their legislative mandate. And particularly if you've got regulators who have been used to doing things in a certain way year after year after year, what we're talking about is change. We are talking about regulatory reform, but in the bureaucratic sense. This is not easy to come by. I think that over time, as the fears are removed and we are constantly trying to explain what it is that we're trying to achieve and what it is we are not, that it will start to sink in that this is the right thing to do. In a globalized economy, particularly an economy where financial service is exceptionally globalized, the need for regulatory consultation and a process, a predictable process by which that takes place. We see, and TTIP is a unique opportunity for this. There's some resistance to throwing it into what some style, and Brad made a very good point, TTIP is not a free trade agreement per se. It is really the new version of what the kinds of 21st century international or binational commercial agreements are going to be. They are not trade anymore. It's not just at the market. It's behind the border barriers, and particularly regulation, where if U.S. business is going to remain competitive in this globalized market, these are the issues we have to now start to address. And my personal feeling is, as I say, this is the right thing to do. I don't sense there's really any sort of hidden agenda in all of this. And eventually, in my mind, and I'm a glass half full kind of guy, obviously, when you have the right idea and you stick with it, it will finally sink in and be adopted. And I have confidence that eventually the U.S. financial regulatory community will see this as not a threat, but actually an ability by which to take their best practices and inculcate them into a more international framework. Mm-hmm. We should see TTIP as an opportunity for this, not as a threat.
Good. Ben.
Thanks. Ben Hancock with Insight Trade. I want to ask a super question about data flows. You mentioned the safe harbor, but touched on that briefly. I wondered if you had gotten any signals that were close to resolution on this. I mean, this is obviously, you mentioned the 13 recommendations, and this is, they've kind of hung up on national security issues, not really related to safe harbor. I mean, do you have any real fear that this is going to come apart at the seams, or is this just a matter of finding a political solution? And then more specifically, you talked about the fragmentation of the internet and some of the proposals in Germany and France. I wanted to ask, you're seeing companies like Amazon just of their own will move some of their servers over to Germany to respond to customer preference over there. And so independent of policy, you see this kind of fracturing already taking place. I mean, do you think that that is going to endure, and regardless of what we ever can do in TTIP, that might continue to be a problem because you've got these different cultural notions about what data privacy should mean?
So I think there's an increasing recognition on both sides of the Atlantic that we're not likely to pass an overarching.
Steve, push your button.
Oh, is that not on? Oh, sorry. Start over. So I think there's increasingly a recognition on both sides of the Atlantic that we're not likely to complete an overarching across-the-board data privacy law along the lines favored by the Europeans anytime soon, and therefore that the safe harbor will continue. The latest I've heard was from Julia Brill, the FTC commissioner, on November 19th, where she reported that the US and Europe have agreements on 11 of the 13 recommendations that Europe has proposed that Department of Commerce or FTC can deal with these, and that the 2 points that are outstanding relate to the extent to which US national security bodies are able to access the data of EU citizens transferred under safe harbor regulations. So I believe it's only the national security issues at play in those 2 of the 13 recommendations. So, I'm confident that we'll get that sorted out. And Vivian Redding, before she's left, Cecilia Malmström, the new EU Trade Commissioner, and Andres Ansip, the Digital Economy Minister now, have all said we think we can get those things solved. So I think we'll get agreement on that. Regarding your broader question about data localization policies, I mean, I think, as ITIP has long said, there's a battle for the soul of the global trading system afoot. And Brad mentioned that, and is the global trade system going to carry forward under the principles of rules of market-based trade, or are innovation and mercantilist policies that fragment global economies and use localization barriers to trade, such as Vietnam is doing this. Decree 72 has mandated that internet companies must now locate data centers in Vietnam as a provision of providing digital services to Vietnamese citizens. Indonesia is considering introducing the same thing. That's why when our European partners, who, to Brad's point, generally share the same values as we do about rules-based free trade, when Europe is considering putting in place those types of policies, that they're particularly pernicious to the global economy. And that's why, getting to the last part of your question, if Amazon or IBM, and IBM has announced $1 billion worth of investments in global data centers, when countries are electing to locate ICT infrastructure and data centers in certain countries for purely competitive market-based reasons, they want to be closer to their customers, they want to cater to the local desires of customer needs, as long as it's being done for market-based reasons, then that's great. In fact, I don't know if you've seen research done by Michael Mandel of the Progressive Policy Institute, and he talks about, and I won't get this exactly right, but he talks about even the fact that we can go on the internet and get a search delivered to us in 2 seconds may seem fast to us, but to the major internet companies, they're trading on fractions of seconds in terms of being able to win market share in that industry. And they recognize that if they are locating servers in Europe to service the European marketplace, that they can deliver a better quality of service to their customers and gain market share. So as long as that's the reason why Amazon's doing that, then that's good.
Very interesting point. Yeah, go ahead.
Follow-up question for Steve.
Could you identify yourself?
Sure, Ryan Dupre, quick question.
Rare breed.
But not public citizen.
I'm here on lunch. So do you think that the lack of privacy or consumer privacy rights is a competitive disadvantage for American companies?
Well, I mean, I think in Europe, there's this now tendency to view privacy as a fundamental human right, Whereas in the United States, there's more a perspective that privacy is a very important right, but you know, it's more viewed more as a consumer right, as one value among many, and as such, we believe that privacy must be balanced against other competing interests. I mean, we at ITIF would certainly agree that internet and financial services companies must put very strong privacy and data protection policies in place. But the reality is that it is very common that consumers will trade off some of their privacy rights because they understand they can gain economic value from it. When you get married and you're looking for a new joint banking account, Citi may be able to use knowledge of that to offer you a very good service, a product that you would not be otherwise aware of. And we believe the internet should operate under terms where consumers are able to make the trade-off of the privacy they want to keep and the privacy they want to share, so that companies can offer value-added services to them in a thoughtful and value-adding way, but yet that protects their privacy.
Someone else? Yeah, right here.
Hi, Jessica. I'm a student at American University. American University. I'm wondering if you can speak a little bit more specifically to the European barriers to trade in financial services that you'd like to see eliminated in TTIP. TTIP is kind of a difficult topic to grasp. So, so just like what specific laws, or what are the specific barriers in the European Union to financial service trade?
You understand that's a really huge question, so maybe
Or maybe a few.
maybe pick an example, guys.
Well, I can start with, these aren't so much, they're the regulatory mismatch barrier that I'd point out. As Brad pointed out, I think in TTIP, for example, the market access is not the big deal for us in financial services. It's more this question of then once you're there and you're operating, you know, are there imbalances in costs? Are there differences in compliance? I can tell you from our experience, and I'm sure from virtually every other major, we'll call it systemically important financial institution, that our compliance costs on a global scale have just increased immensely. It's unbelievable. In fact, I'm thinking of changing my job from what I do for Citi into compliance. It seems to be the new field. I think they're going to get their own building pretty soon. Apologies to my compliance friends. No, but in Europe, I think a good classic example is how they're treating, and Brad alluded to this earlier, how they're treating and weighting the risk for certain types of assets when you go to try to comply with the Basel III capital ratios, liquidity ratios, buffering. It's just there is a discord, if you will, and certainly not an effort to coordinate between how you weight these things, so that certain financial institutions are ultimately having to pony up a lot more capital in order to provide the kind of buffer against risk than others would, who are similarly situated, but simply because their jurisdictions are treating it differently or interpreting the risk weighting differently, you're set at a disadvantage if you're not housed in that particular jurisdiction. That's just one example.
Yeah,
Brad, got an example?
I would say there's not really as Rick said and I mentioned earlier, there aren't really barriers. What is to be lost here is an opportunity. And it's the U.S. and Europe have basically the same level of consumer protection, the same level of solvency regulation. I mean, in the United States, you know, our system is different. We use GAAP accounting for publicly traded accounting companies in the United States. In Europe, they use International Reporting Standards, IFRS. In the U.S., for regulatory purposes on insurance, we actually use a thing called statutory accounting, which is a state-based refinement of GAAP that's even more conservative on its assumptions than GAAP is, to be extra prudently careful. Now that creates a problem between the U.S. and Europe being able to understand and accept each other's systems, because they, you know, one is metric and the other is imperial. But the lost opportunity we have is the U.S. and EU TTIP is not operating in a vacuum. As Rick indicated, following the financial crisis, there was a body that was changed from the Financial Stability Council to the Financial Stability Board, which is a G20 empowered nonprofit Swiss corporation that is basically enforcing global standards for financial services regulation. And it's doing it under the direction of the G20 leaders. Just continued in Brisbane. The meetings are going to be starting in Turkey under the Turkish presidency in 2015. And there is a mandate under the FSB for insurance regulators to come up with standards that all countries must abide by. And when this first happened, it was in 1997 after the Asian financial crisis. And the standards that were adopted were minimum standards targeted at Thailand, Indonesia, et cetera, to make sure you could never have a crisis like that. After 2008, it wasn't Thailand and Indonesia anymore. It was the United States, Belgium, and the UK that had to come up with new standards to make sure that we comply. So it's in our interest as the US and Europe to make sure that we find a way to recognize each other's systems, because we actually do enforce agreements. We do have rule of law in our country. If a company treats you unfairly, you can go to a regulator and file a complaint and expect adjudication. If that happens in some other major markets, China for instance, and it happens to be a state-owned company, and you suffer a major loss and go to them and say, I believe I'm owed money, there's not a lot of independent protection for you as a consumer in terms of having consumer protection. There are different standards of rule of law, there are different standards of contracts. So we see it as mainly as an opportunity that would be wasted. And as I said, effectively the US and Europe are already working to mutually recognize each other's systems through informal means. They're doing it at the regulator level by exchanging staff to be seconded in each other's jurisdiction, to build relationships, to understand how they undertake things. We see it as confidence building.
Brad, if I may, how can TTIP help if it's already going on?
Our goal for TTIP is simply to recognize what's already being done. We have just asked that the US-EU regulatory dialogue project be recognized, and that instead of the report being issued publicly every year, it be issued to leaders with a set of expectations for continued incremental improvement in the next year. And our concern is that I've been doing this as long as Bob has, and 5 years ago, this process started, but it was because of a fairly unique set of circumstances. It was because the financial crisis caused US and EU regulators to come together and work toward a common objective. It was because we had personalities in the state and EU level who got along. There was no political disincentive for the countries to work together cooperatively. That doesn't always exist. Sometimes you will get US or European regulators who, the way they get political points is bashing the other side, or saying, I'm not going to recognize there are systems better. And that you can't guarantee that it will always work. And the only way to enshrine that is to put it into a partnership like TTIP with an ongoing expectation that a report will be given and that continual progress will be made. It's not binding anybody. It's not changing Dodd-Frank. It's just setting an expectation that that regulators will continue to sit down and to try and work to try and find common value that's a win-win.
Okay. So I think Brad has already answered this question, but I'd like Brad Jensen and Steve and Rick to tell us, in their view, what is necessary in your sector? What would be necessary to kickstart, to push ahead, to break the deadlock, in a sense, really get the TTIP started again? Because a lot of us have felt that it's going to take major steps on either side, on both sides. The U.S. could change its position on financial services regulation. The Europeans could change their position on the nature of their offers and services, where they haven't even submitted a text. They haven't even submitted a text on which to negotiate. So there are just lots of steps that each side could take to demonstrate right now or within the next few weeks that they really mean business. Ideas? And by the way, I shall duly note that we have representatives of the Treasury and USTR in the room. Don't be daunted.
Well, I had the honor of sitting at a breakfast with Commissioner Malmstrom the other morning, and I think part of the answer to your question, Bob, is that the Europeans now have a new negotiator. She has a very different style than her predecessor. She's much more personable. Her team's is the same, but I just get the impression she really is going to work at a fresh start. And I suspect that with Mike Froman, given the fact they've set a new schedule for ongoing negotiations, that things will proceed. It's interesting. One senior person of the trade delegate, or the DG Trade delegation from European Commission, actually says, you know, these negotiations are about where we expected them to be at this point in time. Now, I'd point out one other thing. It's not particularly hopeful, but I think it's realistic. These negotiations are going to go through next year. Whether and how they might be handled in terms of a final work product subject to congressional approval in 2016, I think it's highly doubtful. So we really I don't think we need to get too obsessed with, oh my God, we've got to complete this in 2015. As someone earlier this morning said, a gentleman from Capitol Hill who knows what he's talking about, he said, well, I remember Mike Froman said we were going to do this in 1 tank of gas. I want to do this in 1 tank of gas. And this particularly savvy advisor said he could be done in 1 tank of gas. We just haven't started the car yet. So anyway, my feeling is that because of the complexities, as is evidenced by things like Steve and what Brad have been talking about, these negotiations will go forward this year. They're going to tackle some very tough issues. They obviously are tough issues. But I think at the end of the day, as long as we keep our eye on the prize, and the prize really is setting the new set of international standards by which commerce is conducted internationally. Because if we can't do it, if we, the United States, and Europe cannot do it, we're going to basically hand it over to others who are new to the game and are going to rewrite things in a way that are going to be completely unsatisfactory to a market-oriented, liberal trade environment.
Thanks. Steve or Brad, whichever. You want to go first, Brad?
I'll just echo what Rick just said. I think the biggest thing for TTIP is to recast it. It's not about how the U.S. gets its demands of Hollywood movies in France, or the ticky-tacky things, and how the Europeans get Jones Act, or whatever the long list of disputes is in our robust relationship. It's more recasting it as how can we come together to set the rules for the future. Because if we can't do it together, we're going to be negotiating with the BRICS by ourselves. So this is the opportunity, and every day that goes by, we lose leverage.
So, Steve, if you were Malmstrom and you really wanted this thing to happen, what step would you take to build confidence in the U.S. administration that Europe really means business?
From a European perspective?
From their perspective. In other words, what do you want? What's most important?
Well, especially for the information and communication technology sector, which I'm most familiar with, there's a need at the most senior levels.
Push your button.
I think to move the conversation beyond a lot of these concerns about the post-Snowden surveillance revelations, which is still dominating so much of the conversation in Europe. Just last week, Germany's economic minister, Sigmar Gabriel, said that Amazon, Apple, Facebook, and Google represent examples of brutal information capitalism, saying that Europe must act now to protect itself. As you said, either we defend our freedom and change our policies, or we become digitally hypnotized subjects of a digital rulership from the United States. This attitude is all too prevalent in Europe. So I think we need high-level dialogue coming from the president to recast the European perspective on the common values we share, both in the ICT industry, but also, as you said, Charles, to liberalize rules-based trade and put eyes back on the prize of the bigger picture and what we have in common.
Thanks.
And
Okay, any other questions? All right, well, join me in thanking our panel, please.